Today we're going to talk about who moved that stock's cheese. It's a lesson in adapting to change from a business, a stock market, and an economic perspective. We'll jump right in now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Today we're going to talk about who moved that stock's cheese, also known as who moved that company's cheese. We're going to also dive into data, as we always do, going back off of the end of day, Friday, June 7th, looking at all things related to the stock market through capitalization, through the lens of sectors, through the lens of international equities, and through a bond lens. And then for today's discussion, we're going to talk about how a stock falls out of favor. And not just favor in the sense of like a meme stock or something where the public has fallen out of favor with it, but where the stock is no longer performing because the market has changed, the market has moved, and it hasn't kept up with it. I'm not going to give you specific examples of stock. I'm going to talk to you more at the business level, but obviously that immediately comes down to the stock level when you think it through in terms of what happens to the value of a stock or the value of a company, therefore, when it's kind of missed the mark, when things have moved on and they didn't move or adapt with the change. Now, a great way to understand this is through the old classic book, Who Moved My Cheese? Now, if you've never read this, I would recommend that you do, in fact, read it. It is a great book for anybody who works with groups, with teams, who works in business, who is in school, who basically anybody who has to ever deal with change, which is all of us by definition. So it doesn't mean you have to be working or volunteering. It just means you have to be interacting with people. And if you do interact with people, it's a great story that's a very simple, very quick read. You'll literally knock it out in an afternoon or less. And it simply identifies the basic problems that people have in adapting to change. So there's 4 characters in that story. If you do not recall, it's Sniff, Scurry, Hem, and Haw. It sounds almost like a children's book, but honestly, I promise you it is not if you haven't read it. Sniff is an individual or represents an individual who kind of looks ahead. They sniff out. They're watching what's going on with change, and they identify that when that change is occurring, and they're not afraid to make a change or to adapt with the change or to accept the change and move on to the next new thing. Scurry, and I'm giving you some little descriptives here. Scurry is one who quickly scurries into action once change occurs. So they didn't necessarily sniff it out. They didn't see it coming. They didn't anticipate it. But once it happens, they accept it and they move on and change. Hem is one who denies and resists that change, mostly out of fear. They simply cannot handle the unknown or are afraid of the unknown, and it freezes them. And they falsely convince themselves that things will go back to the way they were. And kind of like that old saying, the definition of insanity is to do the very same thing over and over again, but somehow expect a different outcome. That would be basically Hem, afraid to do any change to disrupt the normal status quo. And then Haw is one who did learn to adapt after some change, or some time, I should say, to change, and then started to realize that, hey, change can actually lead to better things, and started to realize how to embrace change. So that's the concept. Basically, it starts off with, there's this huge pile of cheese in what they call cheese station C. They think that the cheese will last forever, but eventually they eat through it all and it's gone. And the cheese has moved. And once that cheese has moved and is gone, Sniff and Scurry eventually take off and they find some new cheese. It takes Hem quite a bit longer, and Haw quite a bit longer, and Hem kind of gets left behind. So again, it's all about dealing with change. So now let's talk about that in more of a business perspective. So television, as an example, has changed dramatically depending on your age. If you're like me, you can remember the days of black and white TV with the rabbit ear antenna that you had to adjust and everything all the time. And then we went into, much stronger antenna systems. Eventually we end up with cable TV. And today we find ourselves in a streaming environment. So just as an example, and it's hard to keep track of all this, candidly, because there's been so many mergers and acquisitions in the media space. But Disney, in terms of overall viewing time, so it doesn't matter how they're viewing it, they're just simply viewing it, whether they're viewing it on a traditional television set, whether they're watching it through cable TV, whether they're watching it through streaming, whether they're doing it streaming through their phone. It doesn't matter what it is. Overall viewing time, Disney is currently number one. Now, Disney includes a whole bunch of other things besides just Disney. There's Hulu, there's ESPN, there's other media sources that are under the Disney umbrella. So it's not just old school cartoon Disney, as you know, but it's winning the race, so to speak. Interestingly enough, look what's number two. Number two in overall viewing time is YouTube. YouTube is, for the most part, homegrown video. Now people are doing high production video and now putting it onto YouTube, but it started off as something where you and I would make videos and drop them out there. And there's still a lot of influencers and everything else using YouTube, but it's become a huge source of streaming and viewing. So YouTube's actually number two. NBC comes in number three. Paramount, which was formerly CBS, comes in four. Warner Brothers, which was previously AT&T, and then Netflix down at the bottom. So Netflix is the historical winner prior to YouTube in the streaming area. But overall, it's lower down. So now that's kind of what's happening here. We're talking about viewing time. Now we're looking at streaming versus TV. So streaming is coming in the red or purple. Gray is traditional TV. So again, Disney's number one up here with the largest amount of total time, but it's about 60-40, maybe 55-45 streaming to traditional. So the reason they've become so successful, it turns out, is because they did a good job of embracing both, and they're getting approximately the same amount of viewership from multiple venues, multiple ways of viewing, from streaming and traditional TV, whereas YouTube's doing it 100% on streaming. And then here's the problem. So here's the who moved your cheese analogy. The traditional television sources of NBC, CBS, AT&T, those groups have had a very difficult time adapting to a streaming world. They're still getting the vast majority of their viewership through traditional means, and that's what's put them behind the likes of Disney and YouTube. Netflix, again, they're second only to YouTube in streaming total time, but then they have zero TV time, and so therefore they're down there at the bottom. But one might think they're poised well to jump above some of these others, depending on how they adapt and strategize to this changing of the cheese, this moving of the cheese that is taking place. And this is just one business example. So the point of doing this is not to talk about any of the groups that are on here or even television in general, but to talk about how it's important for companies, it's important for the economy, it's important for business, and obviously, therefore, important for the stock market to stay adapting to change. Now, you're going to do some swinging and some missing, but you're also going to hit some home runs, and you have to stay attuned to change. So when company stocks are falling out of favor, the first question that you probably want to ask yourself is this a result of a dramatic change that they did not keep up with and now they're behind the eight ball? Or is this some more easily overcome obstacle that could bring their stock price back up to where you might anticipate it to go in the future? So things to think about when you're analyzing business, stocks, the economy, and such. Now, with that being said, we're going to talk about capitalization. So right now, just as we spoke last time, we're seeing a tremendous amount of green, which means we're tilting bullish across all of the different capitalization classes, going from large cap down to small cap. Right here in the middle is the overall stock market, which means that it's large cap kind of winning the day, so to speak, lifting us up. The S&P 100 and the 500, QQQ, which is the NASDAQ 100. We've got a very strong bullish trend. We've got a lot of upward mobility, I should say. We've got all of this trend showing us green down here. We are in a very much an upswing from a bullish tracking on all the capitalization. So pretty simple screen, lots of green. Now, if we go to sectors, there are multiple sectors that make up the S&P 500. If we take an average weighting of all those sectors, we come in right in the middle. Doesn't look all that different from the screen we saw before in terms of what the green is looking like from a bullish tilt. So what's driving the day? We've got silver up here, interestingly enough, but more importantly, we've got telecom, information. We've got, again, gold here with the commodities, and then utilities and financials. Down at the bottom, we have real estate, energy, consumer discretionary, and materials. So we're seeing a couple of little red flashes here on some of the subsets inside of the trending score that we track. But for the most part, we're all still coming in green here, with the exception of real estate, which is in at 0 right now. So right there, kind of pivoting on the top of the fence, if you will. Then if we look at international equities and we take the total international stock market, again, looking pretty bullish overall. Again, lots of green here. Most importantly, what we're seeing is what's driving things. And it looks like, the United States is up here for an example with the S&P 500, but we're seeing lots of European related things up here in the top side of things. And then we've got the Pacific, China, and Latin America down here at the bottom, as well as here's emerging markets. Latin America being the only one coming in with a red tilt or a bearish tilt to it. And then finally, in the U.S. bond market, the total overall bond market is positive, hanging on by a fingernail here with a trend indicator of 5. And we're seeing here a bit of a slide overall, but we just got a little bit of green down here in the lower right. That's why we're showing positive. But again, if you look down here, lots of red in the bond area. And most of that is government bond stuff. So treasuries, ranging from short-term to long-term. The only thing down at the very bottom below that is international bond. Up at the top is your corporates. So we're seeing short-term, high yield, and intermediate term corporates. So not really the long-term stuff, and also the corporate stuff is kind of leading the day. So there is your quick recap of all things relating to the markets, and hopefully gave you some new perspective on who moved that stock's cheese. Talk to you again soon.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.